Hello and welcome everybody. Welcome to another edition of VC TV, Latuk and VC TV, with the Venture Capital TV. Today we are going to discuss early stage venture and seed investments. As always, we have a very exciting panel today. Myself, Tushar Kansal from Consultancy Ventures. I am filling in for the moderator today, so I'll be doing the moderation today and happy to be discussing this wonderful topic. A bit of background about me: my company arranges venture capital and also arranges funds for venture capital funds. We are sector agnostic and closely networked with more than 350 global investors. Today we have a very interesting panel. We have Vandana, we have Mr. Milkins, we have Keshav, and we have Alpesh, all people with rich experience from the venture capital space. And I will leave the stage open to them one by one so that they can first come in and tell something about their background. So starting with Vandana. Vandana, if you could unmute yourself, tell us a little bit about yourself. Thank you.
Thank you, Tushar. So, first of all, thank you everybody for having me here on VCTV over and over again. Um, though, I would like to start with I was in Singapore and Jakarta for 15 years in investment banking. I had my own family office fund there. And I worked as an investment banker and advisor to family offices and angel investors in Jakarta, helping startups from diverse backgrounds from fintech, B2B tech, all the way to consumer startups. I was raising funds for them and providing them with a range of services, just as Convanto does today. After 15 years of staying in Singapore and Jakarta, I came back to India. I did investments for a bit and then returned to advisory. That is when Convanto was founded. And today, Convanto is one of the most well known boutique investment banks in India, led by a female founder. I'm also a venture advisor with Loyal VC, the INSEAD-led Canadian VC Fund, having a core portfolio of 160 investments in more than 35 countries. I'm also a partner with GST Venture Studios, a Silicon Valley based venture builder. Over the years, I've arranged funding for startups and growth stage companies in diverse sectors like edutech, fintech, consumer, B2C, and B2B, agri-tech, health tech, food tech, disruptive tech, and deep tech, as well as non-tech sectors. Please do have a look at my website for my testimonials. This month, I've been nominated as one of the top 10 women leaders in Wealth Management 2021. My expert opinion is often sought by leading business news channels and publications like VCTV, Business World, and I've participated in 155 talks all over the world. You can easily see them on YouTube and VCTV streaming sites. And my website is www.convanto.com. I'm connected with 300 plus investors globally, and I pick up global deals. We are sector agnostic, and our ticket size is $1 million to $25 million. Thank you so much.
Thank you. Thank you, Vandana, for giving us an introduction about yourself. Uh, Coming next to Mr. Keshav, please, if you could introduce yourself and tell the audience here, the viewers here, a bit about yourself.
Sure. Thank you, Tushar, and it's an absolute pleasure and an honor to be here. My name is Chenna Keshavadya. I'm based in Dubai. I go by the name Keshav. I was in London for about 15 years, moved here only about a couple of years ago. My background is broadly split across three different sectors and three different types. The first 10 years of my career was spent with large investment banks, Morgan Stanley, HSBC, Lloyds Banking Group, on technology, product development, post-merger integration, and pretty much the whole spectrum of investment banking from a technology perspective. The next 10 years were fairly entrepreneurial in nature. I founded close to 20 odd businesses, succeeded in a few of them, failed in a number of them. And all that experience taught me how the entire ecosystem works, all the way from an idea and taking it public. That's also incidentally when I did my MBA from London Business School, where I met my current business partner. And I'm currently working on two things. One is advisory with Adan Corporate, where we are a team of around 45 people based in 20 different geographies. And we work on pretty much the whole spectrum of corporate finance, equity, debt, funding, also PVC fund placement, growth strategy, M&A. And most of us have been C-suite executives of some listed business or the other, or managing directors of some bank, i.e. decision-making roles. And we work with small, mid-sized businesses in deals ranging from 300K US dollars to about 2 billion US dollars. I'm also currently I'm also working on a digital assets fund. The idea is to invest in blockchain-based startups and also have a proprietary desk for trading. And we all know how things are progressing and where we see the market going in the next few months, if not years. And the idea is to create and capture value in the process. And there are a couple of other projects that I'm participating in on the blockchain space, especially on the tokenization of real estate assets and the democratization of M&A, working with some very senior people. So it's a pleasure again. Thanks for having me on, and looking forward. Thanks, Tushar.
Thank you so much, Keshav. That's a wonderful introduction. Happy to have you on the show today. Next, I'll call Alpesh to give an introduction about himself and let the viewers know a bit about your background.
Hi, I'm Alpesh Toshi. I have a number of different hats. One of them is being part of Redcliffe Capital, which is a early stage pre-seed and seed investment firm. We've invested in about 35 startups, mainly in India, mainly in tech, and some in life sciences. It's run by DJ Dheeraj Jain, who's based in India till recently, and myself. And also, I'm an entrepreneur building businesses. Areas that I work in are around data and AI, and ventures around data and AI. I've worked in blockchain for about 6 years, and we started building ventures around the application of blockchain and infrastructure around blockchain tech. I love fintech. I love technology. I love emerging tech and emerging business models, things like platform business models. And hence, being on this early stage investor seed, I'm a mentor and I'm on the board of a number of different early stage startups and fintechs. So hence participating in this session today. Thank you.
Thank you, Alpesh. Wonderful introduction. Next, I would request Mr. Melkins to tell us a bit about his background and give the viewers a peek into his experience. Thank you.
All right, I'm a business entrepreneur. I've been building businesses since I was 21 years old. I have done a couple of exits. I have lost a ton of cash, and I've also gained. Nowadays, I'm in the blockchain space as an advisor, as an investor, and also as an inventor. I work in different areas in the blockchain space around the world, being deeply involved with the Algorand protocol and borderless finance.
Welcome to the show, Mr. Melkins. And so to start the show, we are talking about early stage venture capital and seed investments. So, one very pertinent question that we have seen venture capital funds moving in early. They are now wanting to invest even more early, and they want to take more risk. So we have seen Sequoia open Surge program where early stage investments have come in. So my first question is, why the need for going early? And if it involves more risks, then why early? So to start with, let's start with Alpesh. Alpesh, your thoughts on this question?
What, investing early or starting early, or both?
Investing early.
I mean, it depends on your attitude to risk, I think, and where you like to, where you like to invest. I think for me, I like to invest early. I like to work with early stage founders, helping them, helping them go beyond just the idea, delivering some value and getting some early customers. I think that's pretty exciting. But also, I love scaling. I always want to set up the business to be able to scale. So for me, it isn't about just proving the first use case and proving the first implementation for product market fit or problem solution fit. It's really saying, well, how can I take that and scale it? What is the scaling model look like? So early stage is really exciting from that perspective. I like to work with, being an entrepreneur for 20 years. I like to help early stage founders do that and give, and help them find the direction which will help them succeed. So for me, it's a great place to be.
Wow. So that's the challenge which brings the excitement in you, and a lot of people I also meet, they talk about the challenges and the the beauty of investing early. And more thoughts on that. We have Harsh also here today. Hi, Harsh. Welcome to the show.
Hey Tushar, glad to be back. Glad to have you as a host as well.
Yeah. So I'm the moderator today. So a little bit background about yourself for the viewers as well.
Sure. Thanks, Tushar. Hello, everyone. Glad to see a great part of my VCTV family over here. My name is Harsh Shetia. I'm a venture partner with our ventures and the founder for Startup Hackers. Essentially, we help early stage startups raise funds, grow their business through a series of activities. We already have a Facebook group which has over almost 1,000 members, where we are helping early stage startups, kind of navigate the early growth challenges which they face, and helping a lot of startups raise funds, as I mentioned earlier as well. Currently, I'm working with two startups in particular. One is from Canada, helping them raise $15 million Series A fundraise, and we are open to all the sectors, whether it be clean tech, health tech, fintech, marketing, SaaS, anything related to technology. We'll be more than glad to have a look at that. Thank you so much.
Thank you, Harsh. Mr. Melskins, your views on early stage investments, and why do a lot of investors want to invest early? It's some sort of a trend. So your views on that?
Well, obviously, if you are an early investor, you have the potential to make a ton of cash on a little investment. What I like about being early is that I've been there. I know exactly all the feelings that they're going through. And what I participate with beside cash is knowledge. There's no reason for them to do all the stupid mistakes I've done for the last 25 years. And when leveling with business entrepreneurs at an early stage, it's so much fun. And they have the energy that I once upon a time had, and it's great to see going from zero to something in revenue streams within 18, 24 months, and look at the investors surrounding this is, from my perspective, amazing.
Okay, thank you. Interesting thoughts there. I would request next Vandana to give her thoughts around this question, why invest early, and also as a next question that usually a lot of early stage companies keep on coming. So why does a funding round fail? So two questions clubbed in one. First, why invest early? Over to you, Vandana.
Okay. Thank you for both the questions. So I'll answer the first question first. So primarily, one expects to have a strong team of individuals with a large skill set. Now, at an early stage, mostly investors like to invest in the right people over the right product or service. And of course, it is a plus if they already have a product which is doing well in the market, and if they have figured out their product market fit, and if they already have a minimum viable product. And this is why I feel that investors really look at early stage investments, because also of the disruptive technology that the founders bring on the table. Now, coming to the next question, that why does a funding round fail? What happens is that it starts from the basics, which is a pitch deck. uh, many founders don't really know how to present their pitch deck in the right manner. I think a pitch deck needs to be made as per the market standards by a professional, with minimum crisp information, and that will help the founders market their product to the investors in the right manner. Having a video pitch saves a lot of time. Also, many founders box themselves up by giving a valuation way ahead of time, which is why a funding round also fails. Not only that, and not having their DD list in order, and also not having a proper marketing team which is complementing each other. I mean, a proper team like a marketing team, a technology team, an operations team that complements each other. So all these factors lead to the downfall of the investment round that fails. We had two founders, one of which bought a car with the investments, and the other one treated cancer. So I think that education needs to be imparted, that the hard-earned money of the investors is not to burn in buying a car or treating cancer, but to use it for business purpose. That's another reason why a lot of funding rounds fail.
Very interesting, Vandana. Thank you. Thank you
Thank
for giving your insights on this thing. Now, coming to Keshav. Keshav, two questions. First is, of course, why invest early? And second, why early investments fail more often than others? Thank you. Over to you.
Thanks, Tushar. I must say, there are some really interesting perspectives being discussed. From my experience, both as a founder as well as an investor, I think it's all about, number one, the time horizon when you're investing early, right? If you're investing early, it means that the risk is also quite high, okay? And you have a lot more bandwidth as an investor to perform the due diligence. So unless and until the VC fund or the investor is equipped with I would say a rock solid team who can do the due diligence, who can create the deal flow, and more importantly, appreciate that a number of investments will fail eventually, and the idea is to stop them from failing by creating some sort of a rational exit strategy. It is going to be a difficult space to be. VC funds are also driven by return targets, especially what the LPs want, and what the exit strategy. If it's a rolling fund, then the investment strategy is completely different. If it's a 7 to 9 year fund, then the investment strategy varies accordingly. And these days a number of funds are turning into rolling funds, which is one of the reasons the investors want to move as early as possible. So they're focused on pre-seed, seed rounds, because you're easily looking at about 100x return compared to a 10x or in that range, if it's like a growth stage round, right? And coming to your second question about why do funding rounds fail? Again, there are a number of reasons, and this is assuming that the investor is in a discussion or in a series of discussions with the founding team members or the startup in this case. I've seen, again, being on both sides of the table, I've seen that during the due diligence, a number of things which are real, which are not really discussed or shown at the outset, come to the fore, right? Basic things such as the lack of a founder's agreement, or the cap table, and the capital, or the equity that is promised to advisors or investors being undocumented. So something, around the governance always makes its way to an exit, as an exit of the investor in this case. And then there are the other things which Vandana described beautifully, especially around the pitch deck, and the fact that the focus is on the product, the focus is on the engineering, the focus is on the financial model. But in that pre-seed stage or that seed stage, it's impossible to predict what's going to come in the next 5 years, right? So one and then of course the astronomical valuations, and the business model, not right, etc., will eventually sink the deal. And one last point about why deals often do not go through. Um, the target market that is described or that is being addressed is not specific enough. I, I've seen so many pitch decks where they say, oh, it's a $500 billion target market, and if we capture 1% of the market, then we could all be billionaires. It's never going to happen. So the founders, need to be extremely focused on, who they're serving. If they have a set of named accounts or a set of partnerships or a set of clients identified beforehand, that sort of narrows what the product is all about. That helps, with the success of the deal. And of course, the governance plays a big part in it.
Very interesting, Keshav. I think you hit the nail on the head on many points there. For example, the information which the startups present being patchy, and later on during the due diligence, many things coming out, and very interesting. So carrying on from there, Harsh, your views on why invest early, and second, why does the funding rounds in early stage, not the funding rounds, why does funding fails in early stage investments?
Got it. So definitely investing early has a lot of benefits to it, right? Not only that, once it reaches the maturity stage, when you get the exit, not only you get huge windfalls, right? People saw the returns they were getting with Coin DCX and a few other IPOs, the Airbnb's pack which happened last year, 1000x returns the early stage investors got out of that. So obviously, early stage investing goes it can give you amazing windfall. And not just that, a lot of VCs who used to be founders themselves, they enjoy the rush and the adrenaline that they get, right, working with an early stage company, because it has its own attraction, it has its own charm. And when you work with those kind of early stage founders burning the late night midnight oil, a lot of the times even the VCs who used to be founders themselves in the past, they will be more than willing to spend that time with the founders to take that founder to the next level, get that startup to the next level, because there is an undescribable rush when you work with the company at that level. 2 years back, 3 years back, I used to be a founder myself, working my own startup at that point of time. I ran it for 2 years, closed down last year, and turned into a VC then. So looking back at that experience, even though I'm working with a lot of startups, helping them raise funds, and with all that benefit, I still kind of, there's a part of me which still kind of feels that, we need to have that rush of working with an early stage company. And that is true of a lot of founder turned VCs. So that is essentially why, working at early stage is extremely beneficial, investing at that level. As far as why the deals aren't going through, the biggest reason which I see is a lot of startup founders. I feel they don't have a good understanding of what it takes to truly raise funds. Right. A lot of the times, what happens is they tend to have a lot of perception that I should get this kind of valuation or this kind of money, or this should be the amount. So just for an example, just about yesterday, I got a company who is doing a standard tech startup, has done around $20,000 of revenue, and they want to raise $1 million at a $5 million valuation, right? So there's a huge disparity in terms of the expectations of the funds that they want and what they should get within what the current stage is. A lot of times, that kind of stuff is missing. Additionally, a lot of startups, they think all money is the same, right? They don't understand the difference between a regular investor money, a VC money, or something, someone who has an industry expertise and the kind of value that that kind of person brings. They think all money is money. However, that's not the case. There's a huge difference. Even sometimes they want VC money and they want to use it to buy capital assets. Now, if you want to buy capital assets or kind of fund your purchase orders, there are other forms of financing which are available, but founders aren't aware of that, and they just they are looking for equity funding for that, which can be easily done through other forms of funding. So a lot of these small nitty-gritties are there which the founders are not aware of, which I'm trying to build more education and awareness among founders, where they understand the nitty-gritties and choose the right source of funding for the right requirement. So that is a huge challenge which happens at the earlier level. And another point which I would like to mention over here is a realistic self-assessment of your startup is also extremely important, right? What happens is a lot of times as a founder, you are extremely passionate towards your idea, and you think that your idea is going to be that next $1 billion startup, and it's going to completely skyrocket. However, as a VC, I come across hundreds of decks every month, right? We have seen there's very few things which we haven't truly seen, and when we are working with these kind of founders, what we're essentially looking at is to find that one thing which we haven't heard of and kind of grab onto that, because even we are looking for that high potential ideas and essentially something which can surprise us, that when that idea comes, when the startup comes to pitch us, and the VC goes, huh, I had never thought of something like that. That is what you truly need to look forward for, and it is those startups which get funded, because these are those passionate founders who are truly futuristic, truly thinking beyond their pushing horizons, and these are the startups which get funded. A regular idea, it's very difficult to get funded, because we go through hundreds of decks, we attend hundreds of events. It's going to be very difficult to kind of surprise us, right? And once a startup like that comes into the picture, and that the game splits, then it is the VCs who are chasing after the founder. Take our money, we'll be more than willing to put our money into your business.
Wow, yeah, that's very good insights, Harsh. Particularly, it struck me that miscalculation on total addressable market, miscalculation on weighing the technology you are building, and then probably issues around valuation, as to how much valuation should be there in an early stage startup, which sometimes has low revenue and low turnovers. So carrying on to the next question, are there any thumb rules around how much you should be looking for in your funding rounds, and how to determine how much is not too less or not too much, and about meeting of minds of the investor and the founders on the valuation bit. So starting with Mr. Milskins, if you could give your thoughts around this.
Could you start by repeating the question? Because as soon as you started telling the question, your video jammed.
Oh, okay.
Yep.
So, how much should early stage companies aim for in their funding round from the perspective of valuation? How to determine how much is not too less or not too much?
Okay. I'm currently sitting with two cases. The one case I have is tokenization in real estate. Traction is awesome. The company is only 2 years old. The revenue is exploding. It's not big revenues, but it is exploding. What we're asking for is $5 million US. Now, that is quite a lot for a very young company. The reason why I'm going to get the $5 million is on a pre-money called 25, is because we can document exactly what is going on. We are extremely focused on a niche in this line of business, and the investors are lining up because they see that the potential is enormous. Then I have another case, which is also a niche company. It's also early stage, but the company is 2 years old, but they've solved a massive global problem documented by professors around the world. The pre-money validation is a little less but the asking is also it's 1.3 up to $2 million. The reason why they're going to get it is because the team is from within this business and they know exactly what they are talking about. Going forward, if you take a startup in the blockchain space, adept service that doesn't cost that much to develop, but again, it's a niche. If they ask for $1 million or $5 million, they won't get it. But if they take it in stages, saying we need 100 to finish development, then we need 250 or 500 to go to market, then we need whatever they need in the future, they will probably get it. I think you talk about venture capital constantly. There are a lot of private investors out there who are in the early stage. There are a lot of angel networks in major cities around the world who can, get $1, $2, $3 million if they chip in together. I think the most important part is to be very original in what you are doing. You can't just write a business plan expecting that you'll become a millionaire, because the chances are very little. But if you're devoted, extremely focused, and you ask for realistic money, documented, why? I mean, what will the money be spent in? I'm pretty sure that you can get the money. I'm in the northern region of the world, and a lot of seed capital is boosting here, and there are some massive exits. Really big exits in this region right now, because a lot of early stage seed and ventures were chipping in with some decent money a couple of years ago. In this part of the world, it's fairly easy to get funded if you focus. If you want to chip in and do something in the blockchain space just because it's a buzzword, you will fail. I forgot the question, by the way.
No, you answered it quite well. Thank you so much. Thank you so much. So basically, it depends on how original, how the sector-specific things play out. That reminds me that this week we saw $40 million seed investment in a company called 10 Club, which is a Thrasio modeled startup, and this was the highest ever seed money funding in an Indian company, highest ever. So it left behind $30 million of Acco, 30 million of Cred, 30 million of Ind Money, 24 million of Jupiter. So we are seeing big money in seed rounds, and Tiger Global is going big in India since the last 2 months, and we are seeing explosion of such companies here. Next to Vandana, what are your views on how much to aim for in the funding rounds for startups?
Typically, what startups do is, they don't show their business plan to a mentor. They don't have a CFO in their team. They don't have a proper advisor in their team. And they just have not calculated everything before they reach out to any investor. Not only that, what happens is that, if they have invested their own money in the beginning and then they ask for a certain amount of money from the investors, that is when they would understand that how, investment works, and how much money they are utilizing in marketing, how much in technology, and how much in, what is the usage of the funds. Now, if your company is early stage and has a valuation under, $1 million, I think it is not reasonable for any founder to ask for a $5 million investment. The investor would be buying your company 5 times over, and he doesn't want it. So if your valuation is around, $1 million, you can, validly ask for a 200K or a 300K and offer, somewhere between 20 to 30% of your company in exchange. A lot also depends on, the founder what is the technology that they are bringing, what is the disruptive model that they are bringing on the table, and what is the kind of drive they have in as to, and if they have any revenues in their company or no. Also, a lot of funding happens because of the relationship one has with these investors. So I think, if any early stage investments happen, and they are also happen mainly because of the good relationships between the founders and the investors.
Agree.
Tushar, you're on mute.
Yeah.
Thank you, Vandana. I didn't realize I was on mute. So next, moving to Keshav. Keshav, your views on the same, please.
Great question, Tushar. In my experience as both a founder and an investor, I've seen that 5 things are often considered before you aim for the size of the investment, and then decide whether it's too much or too less. Okay, the first is obviously the founding team. If you have a team of engineers, then the risk that one would take is a lot lesser compared to a complementary team, and a complementary team that has both the breadth and the depth. Bonus points if the founding team are not first-time entrepreneurs. Then obviously you see that, okay, people have failed and people have learned their lessons. So the risk of deploying capital on first-time players reduces the overall risk, right? Then obviously there's the legal side to it. What are the terms of the investment? What are the anti-dilution clauses? Who the other co-investors are, what are their terms? Who the angels are, what are their terms? What's the vesting period? If you delve into the specifics of the past term sheets and the cap table, I keep bringing up the cap table in my answers because it is underrated. And I've seen both as a founder and an investor that the cap table plays a huge role when it comes to late stage investment. So in these first few months, the nebulous stages, the legal terms play a huge role. So that's number 2. The third is, what are they going to do with the capital? Are they going to hire a team of salespeople or marketing people, and then they're going to figure out how they're going to do, how they're going to grow, how they're going to get into account management, how they're going to find the product market fit, or whether they're going to invest all of that into product development, and where in that stage they are, i.e., do they have their go-to-market strategy figured out? Do they have an execution plan? Have they identified what markets they're going to start with, what they're going to do if they fail? Do they have a backup plan? What the risk mitigation strategy is in case the product doesn't work in that market? So all these factors around sales and finding that product market fit, and where they are and how concrete those plans are, play a huge role. And if these things are defined, then yes, you can look at more capital. And then the last two factors are, is the product that they're building very unique? Is it the only product in the market? If so, how early are they in that particular that market? If they have competition, how do they plan against competition? How much have their competitors raised? And then depending on how the competitors have fared in that market or the other markets, you look at either raising the amount or reducing it based on what you judge. And finally, who the co-investors are. If the round has just started, and if the other investors, have already, let's say, filled 45 or 50% of the round, then you can look at filling the other 50-odd% of the round. So that also plays a role in the decision. And I think there is one more factor, as in where in the life cycle of that fund or the investment vehicle you are, because if you look at it, if it's a first-time fund, and if you're in year one of the fund, then you would have a fairly decent amount of dry powder to deploy. But then you'll have to be really careful about or over deploying capital, right? But if you're in year 4 of the fund, then you would be, I would say, a bit more pragmatic with how much you can deploy, and then based on that you can write larger checks if required, assuming all these other factors hold good. So,
Thank you. That came actually straight from your experience, and it showed as well. So very interesting insights, Keshav. Moving on to Alpesh. Alpesh, your thoughts on this questions, please.
So I assume the question is how can you increase the chance of being funded? Is that the question we're still working on?
That's the next one. So if you could answer, are there any thumb rules around how to determine how much funds to ask for, and how much is not too less or not too much?
My experience of it is, to be honest, people are really bad at it, estimating how much money they need. The way I think about it is really figuring out what you need to be able to get to a particular milestone. I've been a project manager in my career, so estimating how much time and effort something takes is a skill that you need to have. The challenge is always with early stage startup, and what product you want to build is really difficult to estimate. The way that I would do it, I would work it the other way around. I would say, okay, I've got an idea, but if you can build it without any money yourself, that's what I would do. So if you're a techie developer, build a prototype. And these days, to be honest, you can build something really quickly. You can build something using no-code tools to test the model. You can build a database on the cloud, so it doesn't cost you anything. You can get Google Cloud and GCP to give you, and Amazon to give you free credits. So the first thing I would do is actually get zero money and build something yourself, or find a partner, a tech founder, and work with you to build something. Secondly, in line with that, I would go and talk to a customer, because one of the things that I find a lot is people say, I've got this great idea, I want to build this thing. And you think, well, what's the customer benefit? Why would the customer want it? And so many early stage founders, that's the problem I see, is they just don't understand that you have to sell this to someone and they have to pay you money for it. And not understanding that, frankly, before you're building anything is a problem. Now, obviously, there's an iteration and an innovation cycle to go through. You may not know precisely what you want to sell, and that's fine. But iterating through, I've got this hypothesis. This is what I think the problem is. This is how I'm going to solve a problem for a particular audience. Find those audiences and test it on them. But ideally, just building a simple app. There's a load of no-code tools out there where you can build something in a couple of days. Literally, you can build it in a couple of days. Once you've got that milestone, then raising a little bit of money to figure out what the next milestone would be, which is actually building a product and serving customers. Reid Hoffman talks about it, right? I'm sure if some of you read the Reid Hoffman books and heard him talk about these things, you're building a product and you're iterating on the product as you go to get early customers, and show customers early. Don't wait. Let customers access the thing early rather than late. That helps to drive the need for more money, to say where you're gonna spend it on. Because unless you know what you're spending it on, going for whether it's 250 or 5 million or 10 million or 50 million, you're not gonna know. And I think that, for me, how do you figure out how much money you need? I think I would go through those steps, because when you go to the investor, you can say them a lot more definitively, I need this amount of money and I'm going to do that with it, because you have a bit more of an understanding of the problem you're solving and the customer need. And that gives you a way better and more accurate picture of what the money that you need. And when you go to investor, you look smarter. You look smarter and say, well, I need this much money because I'm going to do this, this, and this next. And for me, that's the way I recommend any founder in early stage. And that, frankly, that's what I do. That's what I do as well. So there we go.
That's very, very interesting. So Harsh, I'll just hold on. I'll just ask from Alpesh first. How can you increase your chances of getting funded, Alpesh?
So to be honest, it's similar to the question that I've just answered, right? The chance of getting funded is based upon not an idea, but revenue, but also if you have revenue. So if you build a product revenue, on our Redcliffe emails, I get so many deals, so many companies come to us with their businesses. And the challenge I find in terms of getting funded, one, very rarely will you get any funding by approaching any venture capitalist directly. You won't ever get that. You got to work with gatekeepers who know investors and have respect from investors around pre-vetting deals. So that's one of the biggest things that I would recommend any early stage founder. Now, how do you find those people? Some of these people are on this call today, but go through your network. If you haven't got a network, join networks and build relationships with people who are either investors or have access to investors, and build trust and trust with them. Because if they're good at what they do, they will have trust with investors on pre-vetting deals. So the chance of being funded is better if you go through that route. You got to have way higher chance of being funded if you go through a gatekeeper rather than going direct to any investor. Secondly, another way of getting higher chance of getting funding is what I described, is proving some of the use cases. And one of the biggest things early stage founders don't do is actually have metrics. When you build the stuff, build the metrics into what you're doing to demonstrate the value of what you're providing to a customer. So you can extrapolate with the data and the metrics to show we're doing this now, this is what works, and this is the metrics we've got, and this is how the metrics will scale based upon proof metrics we've already got. And that will increase your chance of funding, because you can demonstrate you started on the road to showing, here's a problem, I'm solving it, this is how the customer growth is happening, this is how the adoption's happening. And when they see that, the likelihood of getting funding is higher, because you can show an investor that this is just not an idea. I can show that it works by the metrics that I've got, and here they are. So there are two things I would say that are absolutely key parts to get funded.
Thank you, Alpesh. So Harsh, over to you. How can you increase your chances of getting funded?
Got it. So obviously the first preference will obviously be the nature of the startup and the product and the idea, right? That is number one. If the idea is something which is not very attractive, or if it's not very easy to execute, or there's not too much ingenuity, without that it's going to be difficult. So that is going to be number one. Apart from that, a lot of other factors come into the place as well, right? Like the founding team. The most important thing is we need to see the founding members. Why specifically only that team has a skill set to be able to solve this problem, right? That needs to come out very easily and very obviously. As you mentioned about 10 Club earlier, right? If you look at, I know some of the founding team members and some of the core team members of 10 Club, and you look at the pedigree, they have deep expertise working with companies like Flipkart, Amazon. They have deep hands-on e-commerce experience, right? With that kind of team, it's very easy to kind of raise funds, because that's essentially what 10 Club is doing. So, having that kind of team which kind of justifies the fact that, we have deep expertise in that sector, we understand what the situation is, and we know the specific areas, what we need to do to get the startup to the next level. So that is an extremely important element to over there. Additionally, the timing is also important, right? So coming back to the example of 10 Club, right now during COVID, I'm not sure if many many startup founders realize, but there are a lot of M&A deals happening where startups are being sold left, right, and center, right? So this is actually a very good time to acquire startups at a very reasonable price compared to normal times when the prices would be extremely high, right? So that is also something which they are capitalizing on. Right now, you can acquire companies at an extremely low prices, sometimes maybe even like 2 or 3 times revenue. So that is what the companies like Ten Club and others are taking advantage of. I think advantage of is the wrong word, but essentially what the situation is, and they are capitalizing on that. So timing also plays a very crucial role in successfully raising funding. Then we come back to Alpesh's point, right? There are always, if you want to reach out to VC funds, if you directly reach out to VC funds, it's going to be very difficult. You need, the help of bankers. There are a lot of bankers, as Alpesh pointed on this panel, including myself, who have working relationships with VCs and FOs, right? If a startup founder directly goes to the VCs and FOs, problem is if he's not very well prepared to present his startup with the thorough pitch deck, thorough business plan, and everything in place, he'll create a wrong first impression. And with that wrong first impression, wrong first impression will stay in the minds of that VC investor forever. And even in the future, if the startup is doing better, they'll always go back to their first memory, and it'll be very difficult to kind of raise funds from that investor in the future. That's why it's extremely important that make each and every impression count and be as thoroughly prepared for the fundraising process as possible. And that involves a series of steps, having a very solid deck, a solid business plan, and even the right amount of the ask, right? So the original question was, what should be the right amount of ask? If I have, coming back to my original example, I've done $25,000 of revenue and I want $2 or $3 million fundraising for the next 3-4 years runway. No investor is going to fund that. And at the same time, you're kind of breaking the trust that this founder doesn't know what he's talking about. I'm not going to trust this founder with my money. So that's why it has to be extremely prepared. It has to be very meticulous. The fundraising strategy has to be on point. You see, in a fundraising process, there are 100 things which could go wrong, and you need to get all 100 things right to successfully raise funds. But even if a single thing goes wrong, you could lose out on the deal. That's why the preparation is extremely important. And that's why I was just talking to one VC yesterday. We met in Hyatt yesterday, and he was kind of telling me, a lot of VC, a lot of startups had come to me for fundraising, and I kind of said them no, that I won't be able to help them because they're not quite ready yet. And it turns out that they had reached out to those VCs by themselves before they came to me, and they had, the VCs had a bad experience that the founders just weren't ready. And they were like, if they would have taken the help of a banker like you to kind of guide them, situation could have been completely different. But now they've completely kind of lost the way. So that's what happens. You need a solid plan in place. You need a solid strategy in place, and a solid advisor in place who can kind of navigate you through all those challenges which are there.
Great, great. Thank you, Harsh. Next, Mr. Melskens, your views on how can a startup in early stage increase their chances of getting funded?
Well, I totally agree with what Harris just said. Be prepared, but start by solving a problem. And when you figure out how to solve a problem, do the work like it was an exam. You need to be able to answer everything surrounding your business case. And if you don't have access to friends and family who can support you, or early stage investors, again, participate in as many networks as possible. Read a lot. There's plenty of content here. There's plenty of content on YouTube. Learn by people who has actually tried it out and succeed, and also the ones who failed. Then you have the potential to get funded.
Right. Very nice views, deep insights. Vandana, what are your views on the same?
So, the very first thing is a pitch deck. If the pitch deck is not made by a professional, I think that is, it gives a backfall for you to reaching out to the investors, because investors don't spend more than 90 seconds on a deck. Not having a video pitch deck, not having a driving team, a complementary team that complements each other, not having a CFO and advisor on board, reaching out to the wrong investors and doing cold calling. I think most investment bankers who are professionals, they have the right kind of relationships with the investors, and investments do happen based on relationships. So if you don't have the right kind of relationships, you're doing cold calling, reaching the wrong investors. If it's a tech investor, you are, proposing a food deal to him. So I think, there is less chance that you will get funded. But if you, there's a whole series of process. If you have your pitch deck in order, if you have your financial model valuations in order, if you have your video pitch deck in order, if you have made your business plan in the right order, if you have a good technology, and the team has a lot of scope in it, the right kind of people, a humble founder, all these will increase your chances of funding. And I think also, if you don't just be too aggressive and box yourself in by um, giving some high valuation to the investor without actually calculating it in the right manner. So I think this will lead a very big downfall. What I have seen is many aggressive founders, they want particular kind of valuation, and they don't want to understand, they don't know how they calculated that. They don't want to listen to the investment banker as when they give certain suggestions. So these kind of things lead to the backfall of the founder not getting investments. Also, a humble founder and with mind being in the center will always get funded very easily. So I would recommend all founders to read the book The Power of the Subconscious Mind and keep their mind balanced before they do such intense things, and do it in the right manner with the right mindset.
Wow, very well said, Vandana. Keshav, just your thoughts on the same, and then we'll have a round of closing notes from everyone. So over to you, Keshav.
Sure. I'll just keep it crisp and concise. There's only one thing which I feel will increase your chance of being funded, and that is storytelling.
Yeah.
So storytelling, right from the conception of the idea, where you're the founder, you're sitting at your desk, and you're thinking, okay, this is the problem statement, and I can make lots of money for everyone if I turn it into a business. From that point, it's that story you tell yourself that, okay, I'll make this happen. Then you speak to your co-founders and you tell them that story, you sell them that vision, right? And you convince them that they leave everything that they're doing and join you, right? So that story needs to be really powerful. And then you go to your friends and family, ask for that pre-seed money or the founders round, right? And then you build things, and it's again down to storytelling. How do you convince them? We use all these various ways, the pitch deck, the video pitch, relationships, everything that the others beautifully described. We use all those, but at the end of the day, it boils down to storytelling. And then you reach out to VCs and the next levels of for the next levels of investments that you need. But before that, you also tell stories to your clients, right? You sell the dream or the product to the clients, and that requires a different type of storytelling. And if you don't have that experience or that skill within you, then your chances of getting funded, or for that matter selling your product, reduce gradually. So I think it's all about storytelling.
Indeed. I have been on LinkedIn since a long time, and Keshav, you said it right. Whenever we read people who are quoting their experience based on, and narrating it in a story, in the way of a story, it catches your eye, and it also brings out the learnings in a very positive and impactful way. So that was amazing from Keshav. all of you. Thank you so much for today. We are almost, just short closing notes from everyone, starting with Mr. Melkins.
Well, basically, Keshav just said exactly what I wanted to say. So I'll just leave it to Keshav because I fully agree. It's all about storytelling, nothing else.
Right. Right. Keshav, your thoughts, closing thoughts?
Well, I think storytelling is one of the things, but it's also about telling the right story, right? And for that, you need the right set of people. You can't be perfect in everything, so you have to work on getting the right team of founders. And whatever your founding team can't do, you outsource. Like Vandana has been mentioning, like Alpesh has been mentioning. You bring in people, investment bankers, advisors, who can do that storytelling for you, while you focus on what is critical, what is important for the business. So yeah, that's what I think will sell.
Right. Indeed. Thank you so much. Alpesh, you next. Some closing thoughts from you.
I think I live and breathe entrepreneurship and building businesses and tech. I love tech, and I think one of the things that you need in this is passion. You need passion in whatever you're building. Yes, financial returns can be amazing, and that's what people think about sometimes. I don't know, but I think if you find something you're passionate about and you can find a problem that you can solve in that passion, then you can, with all the other things everybody's talking about today, you can make your business successful. You can make it successful. And the good thing is these days, because of the internet, because of digital, because of COVID, accessing money, accessing people, accessing skills, reaching customers is easier than it's ever been. So you can find your passion, find an idea, get it tested quickly, can it. If it doesn't work, don't try to carry on doing it. Can it. If it doesn't work, can it, and find something else. And for me, that cycle is really those things are really important in terms of the early stage. And you can find me on LinkedIn, type my name in and find me. If you want to connect, just let me know where you saw me, heard me, and tell me what you'd like to discuss. And I'm on Twitter at Alpesh as well. Thanks, everyone.
Thank you.
Thank you,
Alpesh. Harsh, over to you, and then to Vandana, and with your closing thoughts.
Sure. Definitely. So startups today, storytelling is an important element, and the inherent idea, the inherent concept, that's also extremely important, right? So startup founders need to understand how critical it is to have a solid fundraising strategy in place, and how important it is to kind of have it completely thoroughly nailed down, right? You see all of these successful fundraisers. None of those startup founders directly had those relationships with the VCs to be able to raise that kind of funds. They needed help. They kind of outsourced it, as Alpesh kind of pointed out, right? So go out, reach out for that help. There are lots of other good bankers and good consultants who can help you out with that, and that is how you can kind of take it to the next level. And if any startup feels they want to reach out to my help, I will be more than happy. You can reach out to me on LinkedIn, drop me a message if you need any help with your growth or fundraising. We'll be happy to discuss on the sidelines. Thank you.
Thank you, Harsh. And Vandana, your views, your closing thoughts before we sign off.
So, great panel today. Thank you for having me here, as always. Great moderation, Tushar. And I could be reached on LinkedIn. And my website is www.convanto.com. And once again, thank you for having me here.
Thank you, everyone. Thank you, Mr. Melskins. Thank you, Keshav. Thank you, Alpesh. Thank you, Vandana. Thank you, Harsh. Myself, Tushar Kansal from Consultancy Ventures. Anyone wanting my help in their business journey, feel free to reach out to me on consultancy.com and on LinkedIn by my name. Thank you, everyone from La Token VCTV, and looking forward to the next session discussing interesting themes. Thank you, everyone, for your valuable time. Have a good day.